It definitely is, Scarlett. I think the market's getting past that a little bit and realizing it's a bit of a battle of the bulge. It'll figure it out. It'll be opening up to question how you do it. I think the ideal way Mr. Trump wanted was to repress the offensive abilities of Iran to close this strait, which they still have. But from a crude oil standpoint, the rest of the world is breaking and breaking hard. Pretty severe demand destruction, and the U.S. so far is okay. Now, right now, WTI is around $89 a barrel. I think that high at 120 isn't as enduring as that peak in 2020 at 130 was, and now it's probably stuck between $80 and $100 a barrel. And there's one key thing I reiterated today, wanted to point out, is if prices don't go down, that surplus of supply versus demand in the U.S. and Canada, which is running around 8 million barrels a day, it's going to go to 10 million barrels a day by 2028. So I look at this as this is a market, it's a bear market that's bounced, much more likely to go down. And the key thing that might make it go down to that level by the end of the year is the stock market dropping a bit.
So, Mike, when you talk to people, traders that trade this commodity here, the oil and gas, are they factoring in supply coming from other parts of the world coming into the marketplace, or maybe even Saudi crude or Mideast crude finding other ways to get out to the marketplace?
Yeah. So people keep using that narrative, 20% of world supply from the Gulf. It's really probably dropping closer to 10% now as Saudi Arabia has found ways to get its pipelines through the Red Sea and out in other ways, and they're finding other ways we'll get it. The key theme, I think, is people remember what happened in 2022 when crude oil popped to 130, and the thing that led us back down was natural gas, and that's done the same thing again this year. It was up 100%, and now it's down almost 20% on the year. It's already done what I think crude oil is going to do, and it's seen what's really happening on a global basis. That price maker status has switched from the Gulf to the Western Hemisphere, led by the U.S., from Canada, Venezuela, all the way down to Argentina, and that's the key theme that's been pressuring prices forever, and that, I think, is what's accelerating. I think people are also realizing if natural gas is a guy and corn peaking, and soybean peaking, this is I think just a dump that it's ready. A pump that's ready to dump. Again, it's all everything's predicated on that wealth effect continuing in the U.S.
Okay, so there's U.S. nat gas futures, which you highlighted, right, and then there's European gas futures, which have not fallen in quite the same way because they do depend on the Strait of Hormuz. How is that looking, and how does that compare to what we saw in 2022?
Scarlett, it's not nearly as high, but it's the demand destruction I'm worried about. Typically, these kind of things, as you're seeing, and not only is it psychological, makes people cut off their consumer spending, but it's actual physical now. Prices have pumped up so much, particularly in gas oil and diesel, in this country, diesel, but in the rest of the world, most notably in Asia, maybe not so much China, so much in Europe, that you can't help but not cut your capital budgeting decisions, certainly from a personal consumer standpoint. And that's the stuff that's not really coming out yet. And it's one key theme that Anna Wong pointed out in our morning meeting, our chief economist, is you're not seeing that top 20 percentile of wage earners yet because the stock market's still doing well. That's why, unfortunately, as a commodity guy, I look at the stock markets, everything now, most notably from things like industrial metals and even crude oil. It could push things lower.